Okay. All right. So class 6. So we're going to go, so in the slide deck that you have, there's 79 slides. And we're definitely not going to go over 79 slides. The deck that Kate sent out, it's sort of a review package. So we start with tax accounting for stock compensation, but then beginning on, just to give you some bearing here, yeah, beginning on slide 27, it just starts a review of the things you need to know for the midterm. And really, this is just a rehash of the first 5 classes material. So there's nothing new in here. It's just sort of pulling some of the highlights from the first 5 classes into a deck, so that if you wanted to page through it and say, yeah, I get, there's a slide on blended rates versus effective rates versus, statutory rates. Like, okay, great, I got that. That might be on the exam. I need to know that. And there's another 60 or so slides like that follow. But again, it's just a rehash. So just to orient you with what's in the deck, don't think like, oh my gosh, there's 79 new slides. How am I going to get through it? It's not 79 new slides. In fact, I'm not sure there's anything new in this deck that you haven't seen in the first 5 classes. It's really just trying to reiterate what we've already covered. Okay, so with that, let's go back through stock compensation. So I'm on slide 4. So slide 4 was the 4 bullets that talked about sort of the process that we go through for every award to figure out how to account for that award. So the first thing we do is in the year of the book expense. So let's say it's 2015, I'm a calendar year company, and on January 1 I grant to somebody an award, and that award's worth $100. The value of that award is worth $100, so the book P&L is going to reflect a $100 expense. Okay, so that's where we start. So the first bullet would say, well, I got to figure out what kind of award that is, and do I anticipate a tax benefit or a tax deduction at some point? If I do expect a tax benefit because it's either a non-qualified option or a restricted stock award or an RSU, then I would treat that book expense as a temporary item. And I would record a benefit now in the form of a DTA, because if it's a non-qualified option or a restricted stock or an RSU, I expect a deduction in the future, and that's what a DTA represents. Okay? So that first bullet should be code to you to say, I got to figure out if this is one of those awards I do expect a deduction for or I don't, like an ISO or an ESPP or a foreign award, or award to an officer where it's non-deductible, or any of the situations where a stock award would not be deductible. Okay? So it's either temp when you expect a benefit, or it's perm if you don't. Okay, so that's really the only thing you do in that year 1 period, though. Everything else on this page is, well, what happens in a later period when the award vests and the employee either exercises an option or vests in a restricted stock award. Okay? So you could sort of draw a line under that first bullet and say, that's the only thing I need to do in the year that there's book expense. Everything else I do is in the year when there's a tax realization event. Okay? And I realize it's not clean like that, like there isn't 1 year with book expense and 1 year with the tax events. But you know what I mean. I'm sort of using like a conceptual year to separate the expense from the tax event. Okay, so then let's say that in year 2, let's use a non-qualified option. In year 1, I set up a deferred. I said that 100 of book expense, I expect a future deduction because it's a non-qualified option. So I treated that book expense like a timing difference. I added it back in year 1, but I expect it to be deductible in the future, so I treated it as a temp. In year 2, I'm sitting there and I've got this deductible temporary difference in my schedule of deferreds for $100 before tax effect. And then in year 2, the employee exercises the option, and let's say there's a $110 deduction. The point is the deduction is always going to be different. Well, not always, but virtually always will be different than the amount you set up the DTA for, right? Because the stock price will change. So the second thing you got to do is you got to reconcile, well, what did I expect, which was 100 in my example, and then what really happened, which was 110. So now I got to identify, okay, there's a difference, and there will almost always be a difference. So you take that difference, and with the third or fourth bullet point, you figure out what to do with it. So in my example, with the 110, there's a deduction of 10 that is above and beyond the DTA I had already set up. So the question is, what do I do with that extra 10 deduction? And the answer is, I reduce my payable by debiting payable, and I credit APIC, equity. So this is where that three-step provision process of payable, deferred, provision sort of breaks down. Because if I apply that three-step process to the 10, I would say my payable goes down. That's step one. I got to debit my payable. I don't have any deferred effect for the 10, for that extra. There is no deferred for that. So you would expect a provision benefit if you applied the three-step process we talked about. But here, there's an exception to the rule that says, in the case of a stock award that's stock compensation related, that benefit doesn't go to provision, it goes to equity. If the deduction was less than the 100, it works in the opposite direction. And so you would essentially blame equity if you didn't get all the deductions that you had anticipated when you had first set up a DTA. And you can do that as long as you have an APIC pool. In fact, we should have asked Ramya what her APIC pool was. Because remember I told you there's companies that either have no APIC pool or a lot. And I'm pretty sure she would tell you they have a lot and she doesn't know what it is. Okay. So let's go.
Good question, Jeff.
Yeah.
So if you don't have any APIC pool,
yep,
it's just both P&L accounts getting debited and credited?
If you don't have an APIC pool, so let's say that, let's say in my example, the stock was worth $100. The award was worth $100 when it was granted. And then let's say that the stock went down and the option went unexercised. So I set up a temp for 100 because I said this is the type of award I would expect a deduction. But if the stock goes down, people don't exercise their options, right? And so that DTA you set up, you never get a deduction for it. Okay? So let's say that we gave a non-qualified option to Ramya. The stock was at $10. We set up a DTA in anticipation of when she exercised there would be a deduction. Let's say the stock goes down to 2, she quits, she just walks, the options never get exercised. Okay? So we're sitting there with a DTA set up for that timing difference related to the award. But we got to do something with it. She's gone, the option's canceled, like it's over. So when we write off that DTA, in that example there is no deduction, right? So there's no payable entry. We don't save any tax. Because again, she just sort of forfeited her award. She just walked away. It's worth nothing. It's underwater. So there's no payable entry. There is a deferred entry because I have to clear the deferred I set up at the year 1. I set up a deferred thinking I'm going to get a future deduction, but now I'm not getting it. So I still have to reverse the deferred. I can't just let it sit there. So I got to credit DTA. I got to get rid of my DTA. And now I'm left with I need a debit to balance the entry, right? So the question is, do I debit provision because I have no APIC pool? Or do I debit equity because I do have an APIC pool? So like that sort of situation happens all the time. People just leave with unexercised options. Nowadays, most companies are granting restricted stock units, like that is the norm. So restricted stock units are always worth something. So you don't see people walk away and just get nothing. But with options, that example I was describing, that would be a common situation. Answer your question?
Yeah.
Yeah, okay.
So in that situation, if you had an APIC pool, you take it to the
If I had an APIC pool in that example, then yeah, I would write it off to APIC. In fact, let me see what Cadence says in their 10K, just to see if we can. We didn't talk about APIC with them. APIC isn't nearly the issue with them as it is for like Facebook. But if I went to the equity roll forward, yeah, so every year they have a line item in their equity roll forward that says tax effect related to employee stock transactions allocated to equity. And every year it's an increase to equity. So that means, in their example, they always had more.
Tax benefit.
They always had tax benefits. Now keep in mind, the number we see in the 10K is a net of a lot of things, right? Like if you all worked for Cadence, when you all started at different times, you got awards priced at different dates. And so, you know, somebody on this side of the room might have had an excess deduction because they started when the stock was low. And then somebody on that side of the room might have had a shortfall because they started when the stock was high. And so the numbers we see here are net. But we don't see a net shortfall with a charge to APIC like we're just describing here. But with some companies you would see that. I mean, that wouldn't be totally uncommon. Okay, any other questions?
So they're debiting expense and crediting APIC. That's what it is, right? With their exercise, or with the shares exercise?
So the question was, are they debiting expense and crediting APIC? Okay, it sort of depends, I guess, on where you start that question. But I would encourage you to think about it not as a debit to expense, but as a debit to payable. Because really what that extra deduction is doing is it's allowing you to save tax. So if I come in and I say, oh, you don't get a $100 deduction, you get $110. I think the easiest way to think about that is I got 10 more of deductions than I was planning on. And the effect of getting more deductions is to reduce my payable. Like that would be like the most intuitive way to think about it. So I would debit my payable because I would owe less tax. And then I would credit equity because I would recognize the benefit of that extra deduction in equity by increasing equity with a credit. That's the way I would think about it.
Okay.
But technically by debiting payable, you are increasing your current tax charge as well, right? Because you're taking it from current tax. Instead of giving all of the benefit to your current tax charge, you're taking it away from them.
That's why I said it depends where you start.
Right.
If you started with the assumption that the tax you really owe is your current expense,
Right.
then what you're doing is taking a benefit that's buried in that expense and pulling it back out to APIC. I think that's a slightly more confusing way to look at it, but it's 6 of one, half dozen of another. So for those of you who understood one way and not both, just stick with the one way that you understand. There's no points for explaining it two ways. Okay. So I was going to go through some of these examples again, the kind of examples we went through last week. Does that help you guys?
Yes.
Okay. All right. So case number one. A company grants a non-qualified stock option. The value, using a Black-Scholes calculation, of that option is 30. Okay? So again, that's not the stock price or the strike price. That's the mathematical value of the award. Okay? The strike price equals the market price of the stock on the date of grant, which is $40. Okay, so I give you an award today, the stock is worth 40, and I tell you anytime in the next 10 years, you can give me 40 and I'll give you a share of stock. That's what that's saying. Tax rate's 40%, and then in the year of exercise, the stock is $90. Okay? All right, so in 2014, which is the year that there is a book expense for 30, what are we going to do? So Kyle, what are we going to do in 2014, what will be our tax entry? And don't skip ahead. Try to actually think. I'm not saying you're skipping ahead, but don't skip ahead so that your mind kind of chews on this thing.
You mean debit deferred tax asset for 12, and you credit the provision?
Right. So you would look at this award and you would say it's a non-qualified option. That's the type of award I would expect a deduction for. So I'm going to treat that book expense of 30 as a temp item. So I'll add it back. I'll set up a DTA for 30 times 40%, and I'll record a provision benefit. Right? And that provision benefit is basically saying, hey, that book expense is going to be deductible someday, just not yet. So pursuant to the matching rule, I'm going to book a provision benefit this year to match the book expense that's recognized this year, right? It's all about matching those two things. Okay, so we end 2014 by having a DTA on our books of 12. All right, so Marina, what happens in 2015? Okay, you're going to debit the current tax payable for how much? For 36. I don't think so. Okay, so let's back up. So how much is the deduction? And Marissa can help you if you want to help her. How much is the deduction that we get in 2015? It's not 90.
50.
How much? So 90 is the value at the date of exercise, and 40 is what we paid. So the difference is sort of the benefit we got as an employee, right? And that income, that gain, that's deductible by the corporation. So the deduction is 50, right? Okay, so Marina, back to you. So we know the deduction is 50 in 2015. So now, if we were going to go through our process of figuring out what the effect is, what would you do? The 50 is greater than the 30, that's right. 40% of 50 is 20, so I'm going to debit my payable 20. Wait, you have to speak louder. I can't hear you.
40% of 30 would be credited to current.
It's credited to what?
The provision?
Okay, not credited to provision. So remember, okay, our process. Step one is figure out the effects to the payable. So we got the payable right. We're going to reduce our payable by 20 bucks. So we're going to debit our payable. Okay, so then we move on to the second thing. Second thing is figuring out how the deferreds change, right? So how do our deferreds change in this example? Kyle said they were 12 at the end of last year. What do they have to be at the end of this year? The award's gone, right? Okay, so we know we got to credit the deferred 12. Okay, so debit payable 20, credit deferred 12. We're missing 8. Right? And that 8 is the excess. That's the amount of the deduction above what we expected to get based on the book expense. So Michael, what do we do with that excess? What do we do with the 8? The credit APEG.
If you don't, it doesn't matter if it's increasing the APIC pool.
So we don't care if we have an APIC pool because this is creating APIC
Right?
pool.
Yeah.
Right. Okay. So what if the stock price at exercise was $45 instead of 90? what would happen? So Emily, what would happen if the stock price was 45 at exercise instead of 90? So go through the whole journal entry thing again. No, starting with 2015. The stock price doesn't change what we did in 2014 with Kyle, right? So assume we're now in 2015, we exercise, and the stock is only worth $45. You're going out of order. Go in our order. What's the first thing we do? Payable. You're thinking too hard. You just got to slow down. Okay, so the first thing we do is we figure out what's the effect of our payable. You're thinking too hard still. Okay, so when the person, let's say you're the person with the award. The stock is $45. You say to the company, here's 40. Give me stock, and I'm going to go sell it in the market for 45. I'm going to make $5 of profit. Right? That's what's going to happen. The company's going to get a deduction for $5. The tax rate's 40%, so that's going to save them $2 of tax. So they're going to debit their payable. Okay. So, how much does our okay, that's the payable, right? Step 1. So now we go to step 2, deferreds. What has to happen in the deferreds in 2015 for this award? Yeah.
So that $30 represent the employee pay, the right to pay for it.
The 30? The 30 just represents, like if I'm an employer and I give you an option, the 30 is the theoretical value of that option. Like you should think, oh, that's great, I just got an option that has a fair value of 30. It's not going to turn out to have a value of 30. That's just what somebody thinks it's worth. And that's how books expenses options. They come up with a mathematical formula to value them and expense that value over the vesting period. So that 30 is just a theoretical Black-Scholes computed number that books uses to expense awards. And in theory represents the fair value of the option.
And the 40 will be the write-up.
The 40 is what you have to pay to get the stock. And so any time in the next 10 years, you can give the company $40 and they'll have to give you a share of stock, even if the stock is worth way more than 40. Right? Like that's the optionality. Good? All right.
There's just one more question.
Okay.
Now, in the previous example where we had an excess,
Yep.
so the total excess has gone through to reduce your current tax charge in the P&L.
Yeah.
Technically, whatever you want to take to APEC now, the excess piece, you got to debit your current, right?
Yeah.
Is that right?
That's right.
So in that scenario, the adjustment is to the current,
Yes.
but in the deficit scenario, the adjustment is to the deferred.
Yes. Everything you said is right, but if you guys aren't following that, don't worry about it. Yeah. Okay. We got to pick our battles. Okay. All right, so the answers are in the slides, but again, there's no benefit in just staring at it. The key is that, you know, you get the motor running. Okay. So, case number 3. Company grants an award that's an ISO. The Black-Scholes value is 30. The strike is 40. And the stock is worth 80 at exercise. And there's an immediate sale. Okay. All right, so what happens with this? Okay, so Megan, what happens in year number 2014, year number 1? Sorry. Right, because it's an ISO, you don't record anything. It's a perm, right? Remember that first bullet in my stock compensation logic? I got to look at the award. I got to figure out, is this the kind of award that's going to throw off a benefit? And ISO is not that kind of award, so I don't do anything. I don't set up a DTA. Right? Okay, Hoy. So now I get to 2015. What happens in 2015? And walk me through the whole logic, like step 1, 2, 3. Kind of go slow and try to cover everything. Hold on, Hoy, I can't understand anything. Sorry. Way louder. You can even do this if you want. Okay, so in 2015, the actual deduction is 40. So far, so good. You're on a roll. Debit tax payable 16. Okay, so for those of you who didn't hear Hoy, she said, I'm going to debit my payable 16, which is the 40 deduction times the 40% tax rate. That's perfect. So then the second thing she did was she just skipped over deferreds, but she was thinking it, and she said there are no deferreds, so I don't need to worry about that. And then the third thing she did is she said, well, normally I would balance that entry with a provision, so I would normally credit provision 16. But in this case, some of that benefit needs to go to APIC. And the amount of the benefit that goes to APIC is the excess of the deduction of 40 over the 30 of book expense. That 10 times the 40% tax rate, that 4 tax-affected benefit, that has to go to APIC. So in year 2015, my net entry is debit payable 16, credit provision 12, and credit APIC 4. Right? And that 12, that's my good perm. I'm getting a good perm in 2015 because in 2014 I had a bad perm. Yeah? All good?
So,
Why good and bad? So in the year that Megan was talking about, there was book expense of 30, and we didn't benefit our payable because it wasn't deductible, and we didn't set up a DTA because we weren't assured of a deduction. So we didn't record any benefits in 2014 for the book expense. So it looked like a perm. We just looked at that book expense and said, I guess it's never going to be deductible. It's a bad perm. We're adding it back, and we're never assuming a future deduction. So it's like fines and penalties. So in year one, there was a $30 bad perm pre-tax. And then what Hoy's saying in 2015 is, I got a deduction. So even though I couldn't anticipate it and set up a DTA, I did get it. So now I'm booking a good perm for 30. Because fair is fair. Like, that's the deal. Yeah?
are there any other perm items other than stock that you have to keep track of your amounts added back? Did that make sense? Or?
So the question is, are there other things like this that you have to keep track of?
Because if it's perm,
Like a little piggy banks of goods and bads? And
yeah.
yeah, the answer is really no, not that I can think of.
So this is it. Okay.
Yeah.
This is weird.
So there's a very controversial proposal out right now by the FASB to change all this. And the proposal is to change it so that all of the good and bad, the excesses and the shortfalls all go to P&L. No more APIC. And so it would just do away with the whole concept of an APIC pool. It would do away with the credit to APIC of 4 in Hoy's example. It would do away with shortfalls to APIC. Everything would go to P&L. And most companies aren't in favor of it because it just creates a lot of volatility in the income statement. But that's a very live thing. That's going on right now in the FASB. And in fact, they just issued an exposure draft in the last few months, and companies commented. And there was something like 70 comment letters that went into the FASB, and most people said they didn't like it. So if you can believe it, people would prefer this.
I was going to ask, what do you prefer? Because I would.
What do I prefer? I don't
thought
care.
This would be easier.
Yeah, I just roll with it.
And that'll be just for the statutory fees, right? Just for the statutory.
No, it would be for everything. So NSOs, RSUs, there would be no more APIC. Everything would go to P&L. Yeah. Okay. Yeah? Good with that? With ISOs? Okay. So Emily, since we had fun before with a lower stock price, let's try that again. Okay. So let's say that the stock isn't 80 at exercise. Let's say it's 45. Those were our facts before. So what happens in 2015 if the stock is only 45 at the date of exercise? We're going to debit payable too. Yes. So I'll restate it in my words, but what you got it right, which is the first thing you do is payable. So debit payable too. We have no deferreds. So this is the type of award we don't have deferreds for, so we skip over that. And then we would normally credit the provision to balance our entry. So normally we would credit provision 2. But in this case, we're getting a deduction for an award that we had a bad perm on. So we had a bad perm in 2014 of 30, and our deduction is only 5. So that 5 is going to be a good perm, because in the year of the deduction, we get a good perm up to the amount of the bad perm. So nothing goes to APIC in this example. The entire 2 goes to provision. So in year 1, your tax expense reflected a perm of 12, right? The entire 30 times 40% was treated as non-deductible. and then in 2015, you recovered part of that with a $2 good perm. You're still net bad perm, but in 2015, you got a good perm. Emily, weren't you the one that said your family had a donut store? I took my kids to the craziest donut place ever this weekend. Yeah, up in Portland. Voodoo Donuts. Yeah. Yeah, they had these maple bars with just a bunch of bacon loaded on top of it. Yeah, we didn't get that. That didn't look good. Okay, any questions on that? On those examples? Okay. In the rest of the slides around stock compensation, I have stuff like, remember last week we were talking about if you have stock comp that pushes you into an NOL and you keep the NOL off balance sheet and you pretend it's not around. Remember all that discussion we had last week? Yeah, that's not on the exam, and I feel like you guys want to focus on what's on the exam. Right? Yeah, doing this for your benefit. So let's not go into that. That's good, interesting stuff, but we should just get the core entries, problem-solving skills. That's what we should focus on. Okay? I like the way Ramya described it, actually, because she described it as a puzzle. Provisions are totally puzzles. That's what they are. Okay, so I'm skipping over all that stuff. Okay, so rather than flip the slides on all the review material, you can flip them on your own time. Why don't we do the problem number 4 from last week's homework? Should we do that? Okay. Okay, so we're going to go over exercise 4 from class number 5. And just so we're totally on the same page, that is this. That's this Judy Limited with income of $1 million. Okay, everyone on the same page? That's the example, the problem we're talking about? Okay. So, we got income, we have meals and entertainment, we know that's perm. There's a depreciation difference, which we know is temp. Inventory is also temp. And then we got a bunch of stock comp stuff. We'll come back to that. We have an R&D credit. Ooh, this is confusing. We have a credit carryover from 14 and then a 15 credit. Right? So that's confusing, and we have both credits from last year carrying forward as well as credits that are generated this year. That's kind of thrown in there just to mess with you a little bit. Assume our APIC pool is 0 and our rate's 40%. See, you should applaud the fact that we're not doing state taxes there. Okay, so let's figure out the provision. All right, so if we're going to do, again, we don't have to do state and then fed because we're using a blended rate. This is easy, right? So we're going to figure out the provision using our 3-step process. So the first step we're going to go through is the payable. And I'm not going to call on you guys through the problem. I'm just going to do it because you've struggled enough, right? That's what you decided? Okay. Okay, so step 1 is payable. So I start with book income of $1 million. I have meals and entertainment of 70, which means I have to add back 35,000. You're going to be my calculator today, by the way, if you're cool with that. Or do you want to be calculator? He was calculator before. You can be calculator today. Do you have a calculator? No? Okay. So 35,000 is our perm add back. Book depreciation is less than tax of 150. So that means there's a deduction in our payable of 150 for depreciation. Inventory reserve went up, so that means we would add it back. Books is expensing inventory reserves, but tax can't deduct it yet. Current year incentive stock option 123R expense, 50 grand. Okay, is that perm or temp? Perm, right? ISO, can't deduct it. Not sure we're going to get a deduction. So we're going to add back 50 here as ISO perm. We got a deduction this year on another award for 100, and the previous 123R expense associated with that was 60. Yeah. So I'm going to show that as 100 deduction, but I would have only been able to get a 60 deduction if I was excluding the excess benefit. So I'm just going to write that over on the side so I remember that. Current year RSU book expense of 35, is that perm or temp? Temp. So we're going to add back 35. And then I have another award where I got a deduction of 40, and I had previous 123R expense associated with this of 85. So I'm going to put in 40 here, because that's my deduction. Okay, and then I'm just going to note over here that I have a shortfall. Okay, so now I got my 1,090,000. I don't know, calculator. What did you get? 88? 880. All right, no sweat. 880. Okay. 880. So 880 times 40% is going to be 352, right? Okay. Now I reduce that by my credits of 35 and 25. So I reduce that by 60. 292. Right? Okay. So my tax return should reflect a payable of 292. Now, if I calculated the payable without the windfall, without the extra 40 that's here, I put it in this other column because I was going to do the payable again without that excess. Okay? So if I did the payable again and said, well, what would 880 be if I didn't claim 100, I only claimed 60? The answer would be 920. 40% of that would be 368. I would still use 60 of credits. So my payable would be 308 if I didn't have that extra 40,000 related to the ISO. And that was my only windfall. Okay? So the difference between these two, the difference is 16,000, which makes sense because that's the 40,000 times 40%, that's the excess. That's what that is. And so I know that my tax return payable has to show 292. But in that 292, this is sort of what Youssef was saying earlier. Youssef was saying, in that 292 includes an excess benefit related to stock comp of 40. So if I was coming up with a journal entry for just my current expense, I would show it as debit payable 292 credit APIC. Oops, I messed up. No, I just got my journal entry totally wrong. It's all good. I don't have a debit to my payable, I have a credit to my payable, right? Duh. Credit to payable, I owe $292. I also saved 16 on that payable, so I'm going to credit APIC 16, which means I'm going to debit provision 308. So that would be my current expense entry, reflecting the excess deduction where there is a windfall. Now you'll notice I haven't dealt with the other award that has a shortfall. I'm only dealing with the one that has a windfall. Okay, and I'm doing that on purpose because the shortfall we'll deal with when we get to our deferreds. So remember Youssef was asking about like what happens current expense or deferred expense for shortfalls. The answer is we deal with it in deferreds, which is why in step 2 we'll deal with the shortfall. The windfall we're going to deal with in step 1. All right? Okay, so that's our year 1 current expense entry. So, step 2. Deferreds. Okay, so here's the way I would organize my thoughts around the deferreds. I would show it in a bunch of columns. So remember how in the Excel template we have the various columns that reflect different things? I would take my beginning of the year. Actually, let me move it over a little bit, make some room. Beginning of the year, end of the year, I would have activity, and then shortfalls. So I'm going to have 4 columns. So at the beginning of the year, I have depreciation. I'm just going to list out my temps. So I didn't start with anything there. I had inventory reserve of 0. I had an ISO and an RSU. Okay, so the key is I had set up a temp item for RSU. I'm going to call this RSU number 2. Because RSU number 1, at least in terms of sequence in the problem, was the award that I expensed for GAAP this year. So I didn't start with anything in my beginning of the year temp for RSU 1 because it just came to be this year. But RSU 2, the second RSU in my example, last year I set up a temp for 85. So the sum of my temps is 85, 40% of that is 34. And then I had credits of 35 as a DTA last year. So I had total deferreds last year of 69. Okay, so you can see how the problem would be tricky because you just got to get like your starting point right to even know how to move the deferreds. Right? Can't get the starting point right, it's going to be bad news. Does that make sense how I set up my beginning of the year deferreds? Okay, so now I know I have to deal with the activity. So I go through my temps, depreciation. So I took an extra tax deduction of 150, which means this is going to create a taxable temp. The reason is in the problem so the question is why do I have RSU 1 and RSU 2? So the reason is there's 2 different awards that are RSUs in the problem. There's one that was granted this year. That's the $35,000. So I'm calling that one RSU 1 just because it comes first. And then the second RSU, which has nothing to do with that first one, is an RSU that vests this year but was granted last year. So that's the second award. So it's like if I gave every one of you an RSU, we'd have like 50 RSU 1, RSU 2, RSU 3. We would track them award by award. I'm happy to blend them together, but I'm sure it would be exponentially more confusing. So we'll do them award by award. Yep. Okay, so I have the 150 of depreciation, and I end the year with a taxable temp of 150. Inventory reserve goes up by 50. That's a deductible temp because it'll be a future deduction. RSU 1 is 35,000 of add back this year, so I end the year with a deductible temp of 35. And RSU 2. So RSU 2, I had set up a DTA of 85, but I only claimed a deduction in my payable for 40. So if I went back to my payable tab, remember, I only claimed this in my payable, 40. That's the only effect on the current expense. So I'm going to match that for at least a moment in time with my deferred activity of 40 here, so that my activity in the deferreds matches my activity in the expense. I've got symmetry. But I know that that means I need to write off the rest of my deferred asset because the award's gone. So I have a shortfall of 45, so that that award ends the year with no temp item. It's gone. Okay? So, the total of the activity is 195, 105, 40%, that's 42. So, my credits, I started with 35, where do I end? 0, right? I used them. So, my deferreds went down by 77 for activity. So all that stuff should match with what's in the current expense. Right? All that temp movement, the 150, 50, 35, and 40, all those numbers, including this 35 of credit, all that's in the current expense. So one side of the equation I have a payable effect, the other side is in deferred. My shortfall of 45 means I have to write off deferred assets of 18. Okay? We'll come back to that in a minute. So at the end of the year, I have 65 of taxable temps net. Okay, so that is my deferred roll forward. Easier said than done, probably. All right. Okay, you get what I'm doing here? I'm trying to tell the story in each of these columns of what the journal entry is that I'm going to book. So, and what I mean by that is I'm going to break my deferred, I'm going to break my journal entry into two entries for deferreds. This will be entry number 1, and this will be entry number 2. So for the activity, my deferred assets are going down. So I'm going to credit DTA and debit expense. So entry 1, when I write it on the next slide, it will look like credit DTA 77, debit deferred expense 77. And all that deferred expense is going to be offset by the current because the effect of all this activity has an inverse effect in the payable section. entry number 2, in terms of writing off that shortfall, now that one's harder because I know I've got to credit my DTA 18. The DTA has to go down. The deferred roll forward shows it, right? I need to move my deferreds to the ending place. So I got to credit DTA 18. The question is, what do I debit? Okay, what do you think I debit? APIC. Yeah, you debit APIC 16, not 18, 16. Right? Because we said we had no APIC pool, but in the current calc, we actually generated APIC pool of 16. So we can use that 16 to deal with our 18 of shortfall, which means the 2 that we can't push to APIC goes to provision. Okay. So that means the journal entries ought to be credit DTA 77, debit provision 77, and then for the shortfall, we know it's credit DTA 18. We're going to debit APIC 16, debit provision 2. How did I get APIC of 16? I got it from my payable tab, because I know that this 16 represents the excess deduction I got for the ISO that saved me more. So when I credited APIC in this entry, that gave me APIC pool. Well, you gotta talk way louder. Okay, so her question is, why are we reversing on RSU2? Why are we reversing 40 here instead of 85? I think it's easier for you to break the journal entries down into 2 pieces. One is the deduction that is going through the current expense, because when you're doing a provision in the real world, you oftentimes want this column to tie to what's in your current payable calc. Because then you know what you're putting through the current for temp items is the same thing you're putting through the deferred, because they should be symmetrical. And then any difference, like the shortfall, you know there's a separate accounting approach for that. So I would encourage you to put through in multiple columns deferred activity, because there's really a different story for how to account for that first activity column than there is for the shortfall. It's easier to break them up as opposed to thinking of the 85 together. You could absolutely combine all those columns and make them one and get to the same place. It's just a presentation thing. When you look at, maybe at the end of class I'll pull up a provision model and I'll show you a deferred roll forward for another company that just has a ton of columns, and every column has its own journal entry that we book from. Okay, so far, so good? I feel like we should make the exam harder. Was it a shortfall or a windfall? Okay. Well, you can do it both ways. I know. I just think it's easier to show you in the deferred roll forward section the shortfall in a separate column, so you can isolate on, there is that shortfall. It's not something going through the current calc. So how do I deal with it? Because the deferred still has to go away, right? Exactly. Because I know in total, this RSU, it's got to go to 0 at the end of the year. And I just want to tell the story of I started at the beginning of the year with a number, I moved some of it through the current expense, the rest of it, man, I got a shortfall, I got to deal with that. I got to do shortfall accounting, right? Okay. So now, should we do a rate rec? Or is that easy? Rate rec? Yeah. All right. Okay, so our total expense. So I'm just going to pull the journal entry from here. Debit provision 308, credit payable. Okay, so we know this is my deferred. That's step 2, and then sort of in reverse order here. Step 1 was debit provision 308, credit payable 292, credit APIC 16. Right? That was step 1. So my total provision then is that 77, that 2, and that 308. So 387. Yep. Okay, so let's figure out how we get to 387. So I have a company that makes $1 million, 40% tax rate. So I start with the assumption that's 400,000. I got to end at 387. All right. What's in between? Shuyan. Oh no, actually Chen. Let me give you first dibs. How disrespectful of me not to have thought of you already. Okay, Swan, you want to go next? What items go in the rate rec? Rhymes with terms. Terms. Right? Try again. ISO. Okay? So the current year ISO 50. $20,000. Okay, Swan, try again. Oh, you should say ISO again. That's a trick question. Just say ISO. Exactly right. So we had the current year expense of 35. That's bad perm for the 2015 grant. But then for the award that was exercised in 15, we got a 60,000 good perm. Right? So we had ISO bad perm. This is BD bad perm. And then we had 60,000 BP good perm. Okay, so for the award that was exercised this year, we get a deduction of 100, but there was 60 of bad perm before, so we get 60 of good perm this year. All right. Kai, what's last? Credits. How much? $25. R&D. Okay. Now, because I got the sun. See, like that, it happens to me too, right? Like I missed the sign, and I'm sitting there adding it up. I'm like, that doesn't add up. That's not good. But don't panic, right? It's just a stupid sign flip. So that should add up. Oh no, it doesn't. It doesn't add up. The class is canceled, man. I'm about to have a nervous breakdown. No. What are we missing? Who knows? Judy, you know? Well, right. That's math. I can't just write 2,000. Yeah, put that in Cadence's rate rack. 2,000. What are we missing? No, it's not APIC. It's the exact opposite of APIC. Shortfall. Right? Remember, some of that shortfall hit provision. We haven't captured that. We're writing off some of our beginning of the year DTA through provision because we didn't have an APIC pool. So that provision expense to write off the DTA when we ran out of APIC pool, that's got to go in the rate rack because that wouldn't be explained by this $400,000, but it's in the 387. So we have a shortfall of 2,000. Now that should sum. And it does. All right, high five. So that's in there as sort of a thing to trick you, right? Why doesn't that go into the rate rack? We already recognized the benefit for the credit last year when we set up the DTA carry forward. So last year, let's say the only thing we had last year was we set up a DTA carry forward for R&D credits. Our journal entry would be debit DTA, credit provision. We claimed a credit. It's a great thing. It's going to save us future tax. We're going to set up a DTA, and we're going to recognize the benefit for creating that asset, for creating the DTA. So in year one, you don't see it in the example, but by knowing there's a deferred there already, you know we already recognize the benefit. So there's no more benefit to recognize. Now we're just using the benefit. It's a timing item, but you're only seeing the back end. You're not seeing the front end. Right? Then it's easy. Yeah. That's right. So the question is, why am I using for the ISO good perm, why am I using 60,000 here instead of the 100,000, which is the deduction, right? So how much is my good perm? What is the logic that I apply to determine how much my good perm is? It's the amount of the deduction, the 100, limited by what? What do you think? It's the deduction, but it can't be bigger than what? The prior year bad perm. Our prior year bad perm, just listed in the example or the problem, is 60. Again, you didn't see it because we didn't do the prior year provision, but I'm telling you what it is. So last year we didn't set up a DTA on 60 of book expense because we said it was an award we couldn't set up DTA for. So that was a bad perm. And then this year we got a deduction of the 60 and even more. So the 60 is good perm. That make sense? Okay. Okay. Let's take a few minute break and let that just, and then we'll figure out what we're going to do next, okay? Okay, so year 2, the company is very profitable. We have perms and temps, more stock stuff, more credits. And like Kate was saying, ignore the dates. Just assume this is year 2 following the last example. Okay. So let's do year 2. Okay, how much APIC pool did we end year 1 with, just so we're all on the same page? 0, good. I'm probably going to need to know that. Okay, payable. $10 million of income, $50,000 of M&E, so we add back 25. Tax depreciation is 100 more. Book inventory reserves are now 20, so they went down by 30. Right, so I just gave you information in a slightly different way. Current year incentive stock options of 50. So that's my bad perm for ISO 1. Current year incentive stock option incentive. Wait, what am I thinking there? Current year incentive stock option tax deduction. Oh, I see. I got a $110,000 deduction. But I'm being tricky because I didn't tell you what last year's bad perm was. Because in theory, you could just look for yourself. Right? So we know last year's bad perm was 50. So if I was doing this again without windfalls, I would only deduct 50. Current year restricted stock unit 123R expense is 40, so I have a 40 temp. Current year restricted stock unit tax deductions 15 grants of 45, and I had set up a DTA of 35, or a temp item anyways of 35. So I'm going to deduct 45, but I would have only been able to deduct 35 if I didn't have excess. I got a credit of 30 grand. Okay, so the sum of that I should just look at your solution probably. Oh no, I'm not sure you wrote it in. Alright, who knows what that answer is? 9830. Okay, 40% of that, 3932. And I claim 30,000 of credits. So 3902. And if I didn't have my extra deductions that I'm going to benefit to APIC, it wouldn't be 9830. It would be 9899. that difference is 28,000. So that 28 should equal the 60,000 of difference here and the 10,000 of difference here. So I had 70,000 of deductions from stock that were above the amount I can run through provision or reverse deferred on. So those are my extra deductions. Times 40% is 28. So I know this is going to APIC. Okay? So this is going to be easy, right? I don't have any shortfalls. Okay. So I did my current. Now I'm going to do my deferred. So I'll do beginning of the year, activity, shortfall, end of the year. So depreciation started at 150, went 100 more, so now it's 250. Inventory was at 50, went down by 30, so it is now 20. RSU, let me try not to confuse you. So what I called RSU 1 was 35 last year. 35 goes away, so I have 0. RSU 2 was in year 1, the second RSU, which was getting a deduction. That's gone. That wasn't even in here. So that's RSU 1. RSU 2, 0 all the way across, because that was already gone at the beginning of the year. And then RSU 3, we'll call it, which was the current year grant, was 40. Started at 0, went up by 40. Oops. Ends at 40. That's it. So that is 65. 40% is 26. Was 125. 40%, 50. No shortfalls. And so this is going to be 250, 60. That should be 190. Wait, hold on. We're doing something wrong here. 155, 125. Oh. So you guys aren't catching me, man. I got my signs wrong again. So this was a credit, and that was a credit. So I was trying to figure out how it didn't put across. So it's still 190. 250 minus 20 is 230. 230 minus 40 is 190. 190 times 40%, 76. And the 76 is all those across. So I don't have any shortfalls because the deduction that I claimed for this was actually in excess. So I don't even have to worry about that. Okay. So I know my entry for my deferred because it's going to be a movement of the deferreds by 50. So I'll credit deferreds by 50, debit expense for 50. Okay. So let's come up with a journal entry for this whole thing. So the current, step 1, is going to be debit provision, credit payable, credit APIC. And step 2 is going to be debit provision, credit DTA of 50. This was 50. And that was 28. and that was 3902, and this was 3930. So my total provision, 3980. So if I try to do a rate rec, so if I'm doing a rate rec, I know I have meals and entertainment 25, that's going to be 10. I know I have a bad perm on my ISOs, that's 50, so that's 20. But I have a good perm on my ISOs of 60, I think. Is that right? No, 50. My bad perm last year was 50, so my good perm is going to be 50. So I have a good perm of, I just typed the same stupid thing. Good perm of 50. So I have an R&D credit of 30,000. So this is tax affected, so that would be 30. Boom, rate rec. Okay? So life without shortfalls is easy. Right? You know what I mean? That weird deferred stuff. All you got to do is calculate your payable two ways and isolate what the difference to APIC is. So if Kate likes you, maybe the exam won't have shortfall. But probably not. Okay, questions on that? No, the good perm. Remember, we got to go back to our facts. The good perm, yeah, it can't be, no, it's 50. It's last year's bad perm, which is this. Okay. Wait. It's the international sign for something. This one? You don't understand how I get the 9,900,000. Okay, so what Hoy is talking about is how do I calculate these columns? So here's what I would describe this as. Most of you haven't done provisions, but if you had, most people would refer to this as the so-called with, and this would be the without. And what that means is you do your provision with and without windfalls. Okay? So in the first column, when we did it with, it's sort of a tax return. It's everything. It's everything that's going to end up in your tax return. It's sort of the logical way to think. Okay? So you put in the entire tax deduction of 110 and 45, because that's what's going to end up on your tax return. Right? If you did your provision again, excluding the excess deductions that were the amounts that are going to APIC, then all these numbers would carry over. The 10 million, the 25. I just didn't repeat them in the second column because I was lazy. But if I put all those numbers in the second column, really all that I'm changing is the stock deduction numbers. I'm saying everything is the same with and without excess deductions except for the stock deduction. Right? And so I just didn't draw the numbers over. But had I would complete the second column with all the same numbers, and the only difference would be the stock deductions would be excluding the excess deductions. That's what that without column means. Okay, it's without the excess deductions. Okay? And when after I compute my payable both ways, I see what the change in my tax liability is, and that benefit, that reduction in the tax payable, because I've included the stock excess deductions, that benefit goes to APIC. So really, I'm just doing my payable calc twice. I'm doing it with and without the windfalls. Okay, questions on that? Can we look at the deferred schedule again? Yep. I'm going to send you this. Okay. Okay, so now we're going to talk about return to provisions. So in this problem, we had year 1 and year 2, but there wasn't any correction of year 1 before we carried forward to year 2. The assumption was year 1 was perfect. The provision, we set it up, the return was exactly the same thing. There was no need to true up the year 1 balances before we moved on to year 2. Okay? But now we're just going to sort of say, well, hypothetically, what if that wasn't right? What if the return was different than the provision? Like, how would that look? Okay? So we just going to sort of play it out. Like, I don't have a preset solution, so we'll just make up facts. Okay? So let's get our bearings on year 1 again and make sure we know what we're talking about. Okay, so in year 1, we said that our payable per the return was $292, and we said our deferreds at the end of the year were $26, and we calculated our provision. So let's say that we were doing a tax account roll forward. Okay, so let me just move this up into here. Okay, so remember, these were my journal entries from year 1. Let me put them into like a tax account roll forward format so that we can roll things forward here. Okay, so let's say end of year 1, and I have payable, DTA, provision, cash, APIC, and mystery account, in case we need to plug the balance sheet. I'm just joking. Okay, so if I booked my entries from year 1, let me not start with end of year 1. If I was actually booking year 1, I would have my current entry and my deferred entry to get to my total balances. So my current is 308, 292, and 16. 292, 308, 16. My deferred was credit deferred 95, debit 8, credit deferred 95, debit 8, APIC 16, debit provision 2, 19, and then this was, oh, I got it wrong. So my deferred's got to move by 75 and 18. That's 95. APIC has to move by 16. I got that. Provision has to move by 79. Okay. So if I had put my journal entries into a format of a tax account roll forward, I would have ended year 1 or beginning of year 2 with a 292 payable, 95 of deferreds, and then when I start again in year 2, I don't really need to roll forward my provision. The provision is sort of a year-by-year thing, right? So I'm going to say that, yeah, I booked that stuff last year, but if I'm moving on to the beginning of next year, it doesn't really roll forward, right? Same thing for like cash APIC. All those accounts we're not really rolling forward. All right. So now, let's say that that's what we booked. And now we have differences. So we file our return. Our return looks different than the provision. So the question is, what should be the entry to true up for the differences between the return as filed and the provision as calculated? Okay? All right. So Chen. So meals and entertainment was a 35 add back in year 1. And let's say that it was a 36 add back. Okay, so my tax return reflects a slightly larger add back for tax return purposes than the provision by $1,000. So I need to book my return to provision entry. So what is my return to provision entry to address that? So I need to book an entry. What is it? So I would encourage you to think payable, deferred, provision, right? 3 steps. Payable, deferred, provision. So the add back is 1,000 bigger than we planned on. So what does that do to your payable? It can go up or it can go down. It goes up, right? Our add back is bigger. So if our add back's bigger, our taxable income is going to be higher. If our taxable income is higher, our tax is going to be larger. Okay? So our payable needs to be bigger. We're not going to owe 292. We're going to owe 292.4 because we're going to have 1,000 more of add back times 40%. So our payable has to go up by 0.4. Okay? What's step 2? Deferreds. Are there deferreds? Chen, when do I get that $1,000 deduction? Next year? When do I added back the 1,000. When do I get to deduct it? Never. Right? It's permanent. So there's no deferreds. Okay, so payable. We increased my payable 0.4 because I owe 0.4 more. I didn't do anything to my deferreds. So what's the other side of the entry? Provision. What's going on? Okay, so it seems like it's working again. Okay. So we said that the other side of the entry is going to be 0.4 to provision. What's going on with the pen here? Okay. All right, we follow that from a return to provision perspective? Okay, so let's do another one. Let's say that my depreciation, I originally said it was a $150,000 extra tax deduction. Let's say that it's only $140,000 of extra tax deductions. Okay? So let's assume that all this meals and entertainment business is not right. Let's get rid of that. Let's not confuse the issue here. Okay, so let's say that my only return to provision difference is depreciation. So I thought when I was doing my current calc that my difference right here was 150. But let's say that it was 140 instead. I got it wrong. Okay, so the question is, how would that affect me? What return to provision journal entries would I book in my tax account roll forward to reflect a depreciation difference? Okay, so I need to come up with a journal entry to deal with my depreciation difference. It's $10,000 less tax depreciation than I planned for. Okay, what should we do? What's the first thing we always do? Man, you guys are like my boys. You're like, you talk at them, and then it's just like, payable. Right. Except with the boys, it's like, don't touch, don't touch. Don't touch, don't touch. Right? Don't touch. All right. Payable. What's the effect of the payable? Debit or credit to payable? Credit. Less tax deductions, that means more taxable income, means a bigger tax, means we owe more. So $10,000 of additional income means $4,000 of additional tax. Right? So that means my payables got to go up by 4. Okay, that's step 1. What's step 2? Deferreds. Does this change my deferreds? Right. How does it change my deferreds? Right. I had a taxable temp difference of 150 in my provision, but it really should only be 140. So my DTL for fixed assets, it was 40% of 150. Now it needs to only be 40% of 140. So my DTL needs to come down. Right? So I'm going to debit DTL by 4. So I don't have any provision. Right? So the temp item in a return to provision context is rate neutral. It doesn't impact expense because it's just a reclass between the tax I'm going to pay currently and the tax I'll pay in the future. So temp items, RTPs, people refer to it as a balance sheet reclass, and this is why they say that. So all we're doing when we do return to provisions is we're taking the tax accounts that we booked last year and we're just fixing them, and we're fixing them through balanced journal entries. And we're fixing them through first fixing the payable, then the deferreds, and letting the provision pop out. And I won't ever test you on, like, what if the excess deduction from stock option needs to be trued up and it's different. I won't mess around with that. Okay? Does that happen? Yes. Will it happen on the exam? No. Okay. So that's the return to provision. I tried to make it easier by just showing like one factual change instead of like it all changed, right? All the perms and all the temps and all the apportionment and all that changed. But if you can just get the concept that we just take changes by recomputing the payable, recomputing the deferred, figuring out what the provision adjustment is to correct those balance sheet accounts, that's all the return to provision process is. That's all we're doing.